In this section right here, I'm helping him go over how to actually calculate this company's total enterprise value and total enterprise value, because as deep value investors, we do
Okay.
not want to consider the massive amount
Yep.
of goodwill and intangible assets from this company. So we're actually going through it one by one, step
Okay.
by step, how to calculate this company's enterprise value and total enterprise value.
Point four or four? Oh yeah, 3.4. Yeah. Okay.
I'm also explaining step by step the process we're going through to calculate these numbers as well.
Are you, are you looking at like total enterprise value? Is that what you're trying to get to? 139. So let's say 140.
If you're following along, you may notice that we're evaluating and valuing just one of the acquisitions they did. And I'm doing this to show him
That's
and
how.
illustrate to him why or how this company massively overpaid, and while they'll likely have to write down goodwill at some point.
Yeah. So the 140 is more of a true indicator of the worth of the company, right?
Yes, he's correct. The 140 amount that we come to is the approximate value of the company's hard assets and balance sheet minus goodwill and intangible assets of the company they acquired. Let me clarify that.
Yeah. They paid 2.5 times, roughly, what the true value is.
What he means here, and the number we came to, means that what the company actually paid for the acquisition, they paid 2.5 times what their net balance sheet
Got
is
it.
worth after subtracting goodwill and intangible assets. This is a massive overvaluation of this company, and we'll get to that further as we go along here.
It's 11 times overvalued.
What he means here and what I'm explaining to him is that the number we came to, the 140 million of the net balance sheet value that
Got
the
it.
company had, is since the purchase price was, or that should have been the purchase price, they still would have paid
Wow.
11 times what we value the net balance sheet assets at versus net purchase or net assets acquired of about 12.5 million versus a total estimated purchase price of what we estimate they should have paid of 140 million just for the assets.
No, that's a great point. And what I'm seeing, what I kind of read through that, I'm assuming the other acquisitions are like this without going through it. But let's assume the other acquisitions are like this. It sounds like, and a lot of managers, my company included, have the kind of do something bias. The way to grow is buy companies, mergers and acquisitions. That's the way to grow. So that we gotta buy something. Where Buffett and Munger are kind of the opposite. So it sounds like they're a little.
He makes several great points here, and this is why I will not invest in the weed and marijuana market at this time in any circumstance in the United States, because
Got it.
everybody in this industry is making insanely valued acquisitions just so they can say they're doing acquisitions, because everybody else in the industry is doing acquisitions, and they are massively overpaying for what they're getting in terms of balance sheet strength and operational value.
Got it. So what? So how much was cash and how much was stock? So it was the company was 350, 334. I think it was page five.
Here we're transitioning to look at how much cash the company used to value or to buy this business, and how much equity they used to buy this
Yes.
business that they massively overpaid for.
Okay. It seems pretty close.
What I'm talking to him about here, while I'm looking for the specific numbers in the financial reports, is that this is
Okay.
one of
Yeah.
the
It's like
major things you
it's like
need to look for when looking at any company that's done acquisitions, is how they paid for it. If they paid for it in shares, that means the other previous shareholders have been diluted. In this case, at
okay.
a massive overvaluation, which means they have accrued negative equity, and they've decreased.
Yep.
Not only have they decreased the value of their own shares, and their potential future earnings of the old investors, but since they massively overpaid for this acquisition and other acquisitions that they made, that they are automatically destroying value when every time they acquire assets, whether they pay in cash or they pay in equity. In this chance, or in this place, they paid in equity 100%.
Exceeds the recovery. Right. Well, I had to take a stab at it without really trying to wrap my brain around it. Is they're trying to, like, if it's a building or land, they're trying to do market value instead of historical cost. I'm assuming.
No.
What I'm doing here is, while I was looking for those numbers for the acquisition, I found where they talk about their goodwill, which we talked about earlier in the previous session, or in the previous video, and I'm explaining to him, going over a teaching mode, which is you're explaining exactly why and what's happening with the goodwill.
What does it mean when it says is evaluated for impairment annually? What does that mean, impairment?
What that means is the company evaluates their goodwill on a yearly basis every year to see if they need to write down or write off some or all of the value of goodwill.
But if you have to write down, is that technically?
In accounting terms, when you write off or write down goodwill, it's actually called impairment. When they talk about goodwill, it's a little bit different than some other accounting terms. So you have to watch out for when a company is impairing goodwill. Why is that bad? If you impair goodwill in part, you're destroying, or you're getting rid of some of the balance sheet value. If you impair goodwill fully, which means essentially you write it all the way off your balance sheet, you destroy the full value of goodwill. And again, that will lower book value, that will decrease the book value and shareholders' equity of the company, and destroy value within the company with the stroke of a pen.
Okay. I'll put that as a homework assignment to kind of dig into the goodwill impairment. That's typical wording for goodwill, the impairment.
Yes, goodwill is typically impairment. It's not writing off or writing down like in most other or many other accounting terms. Why? I'm not really sure, but my thinking is that because if you impair it, I know with goodwill, if you impair it, you can bring it back if you deem that at some point after you impair it, it becomes worth what it was originally worth again. Again, with a stroke of a pen, you can increase book value in this case.
Which to us, to you and I, that's not a big deal because we don't put a lot of value, if any, on goodwill.
Yes, he is 100% correct here. As deep value investors, I do not consider most goodwill, 99.9% of goodwill, as a positive asset on the balance sheet.
No, that's interesting. Yeah, because if company A is buying company B, they don't really know the ins and outs of company B. Yeah, they could look at the books and maybe tour the plant, but they don't know the deep ins and outs and nuances of the company.
Exactly. Perfect point here by him.
So 337 share-based reserve almost look like they paid for it completely in shares, assuming the share-based reserve and the share-based is 349.
Here we get back to talking about how they paid for the acquisition, and yes, we find out that almost 100% of the acquisition was paid in equity, which again dilutes old shareholders, and since they massively overpaid for this acquisition and other acquisition, they are destroying massive amounts of shareholder value.
149 on Morningstar.
Why is that different? Yeah, there was. I remember looking at that difference. This is the 10K.
Here we notice that there is a pretty substantial difference in the number of shares on the company's financial reports and via listed between their financial reports and sites like Morningstar, and I'm explaining to him why that could be here, which I'll get to again next.
Yeah, the trailing 12 months is 149, and there was a reason. I noticed that too, and I looked into it, and then I said, "Oh, that's why." I forgot.
Since I always 100% of the time use diluted share count in my valuation calculations and analysis, I always want to know what the financial reports say. But having said that, why is there such a massive difference between what Morningstar is saying and what the financial reports say? What we were using here for the financials were the annual report. So what could have happened here is they could have issued more options, they could have issued more shares. There's likely some financial engineering going on here of some kind, which would lead to the pretty substantial difference in number of shares. Again, you always have to look at stuff like this because companies, especially when they're doing a lot of acquisitions with equity, can do a lot of funny things with their number of share count, but you want to always be the most conservative when you're using the company's share count, so you get a conservative valuation and probably in this case a realistic valuation because they're diluting shareholders in a massive way.